Hello everyone, my name's Philip Bradford. Thanks for joining us in this session. I'm going to be talking to you today about how to generate inflation-beating returns for conservative investors. We've been through some tough markets over the last few years, and for many of you that have been looking just to beat inflation, it's really been a tough time in your traditional type of balanced type investments that your clients have been invested into. So I'm going to be talking a bit about the past. I'm then going to talk a bit about asset class outlooks, both for local and global asset allocation, as well as specifically on South African bond and fixed income assets. And then I'm going to give you a guideline of how you can position your asset allocation in the future in order to generate these conservative but still good returns for conservative investors. Just briefly, in terms of myself, I'm the Chief Investment Officer at Sasfin Asset Managers. I manage not only the Sasfin Flexible Income Fund, but I also manage the Sasfin Balanced and the Sasfin Prudential Fund. And for all of those, we have won awards, particularly our Balanced and our Flexible Income Fund. So with me talking not only about fixed income, talking about asset allocation, it really comes through in the portfolios that we manage. So as I said, I'm going to be talking about inflation-beating returns, but particularly in the context of our flexible income fund. First of all, if you're going to drive from Johannesburg to Cape Town, which car would you choose? Now, if you're in 1980 and you wanted to choose a car, you've got to travel 1,400 kilometers, and if I give you a time of 12 hours to get there, you would have to travel at an average of 117 kilometers an hour. Now, in 1980, if you chose a good South African-made car, this was the Land Rover R6, proudly made in South Africa. It had a top speed of 110 kilometers an hour and a 0 to 100 speed of, well, they didn't really give you a speed on this kind of car in those days. Now, what you can see immediately, with a top speed of 110, there's no ways you could get to Cape Town in 12 hours at an average of 117 kilometers an hour. So you would need a faster car. And that's where the Ford Cortina XR6 Interceptor would have come in. This was also made in South Africa, proudly only in South Africa in 1980. And it had a top speed of 196 kilometers an hour and a 0 to 100 speed of 8.8 seconds. It was a dream car for any guy in the 80s and the 90s, and it was probably the first affordable supercar for South Africans. Now, this was the car you would obviously choose because it was the car that could not only get you there reliably, but it could get you there within the time frame you wanted. In fact, even probably a little bit quicker. And you probably would if you were driving a Ford Cortina XR6. Now, if we move forward to 2020, and you've got the same task, you need to get to Cape Town in 12 hours, you could still choose the Ford Cortina XR6 and get there within time, within that 12 hours and maybe a little bit faster. Or you could choose a Land Rover. Now, if you take the Land Rover Discovery that's come out in 2020, that's got a top speed of 224 kilometers an hour, and it's got a 0 to 100 in 7.3 seconds. So not only is it faster, it's probably a lot more reliable than the Ford Cortina. Now, some of you out there might still choose the Ford Cortina because it might be a bit of a throwback to the 80s and the 90s. But if I change and add some more information to the situation, like if I say, well, what passengers have you got in the back? If you're going to drive to Cape Town with maybe some of your clients' grandchildren, maybe you've got 3 little babies in the back of the car, what is the terrain? What if there's potholes in the road? What if the weather's poor? If the visibility is bad? If there's mist on the road? What about safety? I mean, the Ford Cortina didn't have airbags, didn't have power steering, didn't have any of the safety features that you would get nowadays in something like the Land Rover Discovery. And if we add all of these things together, the decision would have to be a Land Rover Discovery in terms of safety and in terms of getting there. And it's very similar to me as an investment manager, as a fund manager. I need to make sure first and foremost that my investors get to the destination. So safety is the most important thing. And then secondly, I need to get there in a certain time frame. So speed is important, but it is not the most important thing. I will choose safety over speed any day of the week. And for me as a fund manager, I would always be choosing something like the Land Rover Discovery. And this is very similar to how I would actually manage the assets. And if we move backwards again and we say, well, we've got a lot of equities in our portfolio, a lot of South African equities, and why do we have so much? And if I go back over the last 35 years, and the reason I've chosen 35 years is because this is the data that fund managers, asset allocators like myself, your actuaries in your life companies, anyone who's built your advice model for you would use this kind of data. And if you go back over the last 35 years, inflation's been just under 8% at 7.7%. But the South African stock market has actually done incredibly well. And if you have a look, this data, by the way, shows all these returns in rands. So for global equities and global bonds, it actually includes the rand appreciation. So the rand moved from about 2 to the dollar to over 17 where it is today. And that depreciation has added about another 5 to 6% per year return onto global equities and global bonds. But the South African stock market actually did an overinflation plus 9% per year over that period. So a bit like that Ford Cortina in the 80s and the 90s, it really had a really high top speed. It still beat global equities. So global equities, particularly US equities, did nothing for the first 10 years of this millennium. So South African equities, even though it's had a terrible 5 years, has actually still beaten global equities even with the rand appreciation. Now, if you wanted to get a return of something like inflation plus 6, which is normally the kind of target that's been given to you by your clients, maybe even inflation plus 5, you needed to invest in our local stock market and the global stock market. And even property, which is down 40% over the last 5 years, still gave you inflation plus 7 over that period. So if you needed to achieve inflation plus 5, 6, or 7, you had to buy equities. The difference is that things have changed quite significantly. And like the Ford Cortina XR6, local equities were very good in the 80s and the 90s and the early 2000s, but they're not the right option to choose, I believe, anymore. So these are South African real returns, so returns above inflation over the last 120 years. The South African stock market has been the best performing stock market in the world over the last 120 years, even though it hasn't done well over the last few years. And if you have a look on the slide over here, you'll see that equities did inflation plus 7, bonds did just under 2%, so inflation plus 1.9 over inflation. And it's also surprising, by the way, that inflation was only 4.9 over the last 120 years, because over the last 40-odd years, there's been quite long periods of time when inflation has actually been in double digits, both locally and even in some of the global developed market countries. Cash gave you 1% above inflation, and global equities with the depreciation, as I've mentioned before, still underperformed local equities and did inflation plus 6.5. Now, if we go over the last 10 years, equities in South Africa still did quite well. They still gave you inflation plus 5, but bonds actually gave you a little bit better than they've done over average. They gave you inflation plus 2.8. And that includes, by the way, in the last 5 years, we've had the two biggest sell-offs in the bond market history in South Africa. Cash still gave you just over 1% above inflation. And global equities, you will see, in the last 10 years, has had an amazing time, particularly with the rand appreciating, and has given you inflation plus 14% per year. And then if we look over the last 5 years, as we know, local equities haven't done well. They've just marginally outperformed inflation. They've underperformed cash. Bonds, with the two biggest sell-offs in our history, have still given you inflation plus 2.9, and cash has given you inflation plus 2.7. That's going to definitely fall away now with interest rates dropping. And then global equities, as I've mentioned, have given you about 10% above inflation over that time. Now, importantly, what is going to happen next? We all know that what happened in the past doesn't necessarily happen in the future. So here also, when we look at this asset allocation, it's very important to understand risk. If we just look at returns and we don't understand the risk or the variability of returns, we can get things wrong. Now, risk for me is the certainty of getting to the target at the end of the day. It's a bit like traveling to Cape Town. I need to make sure I'm going to get there. What is the chance of me breaking down on the side of the road? What is the chance of me getting there really, really fast? If we look at equities over time, crazily enough, domestic equities have given you, in the best year, and this is on a rolling 12-month basis over the last 120 years, the best return South African equities gave you over one 12-month period was 79%, and the worst return was under 40% negative, so a loss of over 40%. So you'll notice straight away that on average, it might have been inflation plus 7, but in a good year, it could have been as high as over 70, and in a bad year, below 40 and minus 40%. Similarly with global equities, highest return of just under 60% in 1 year. This is with the rand appreciation, and in a bad year, over 45% down. Domestic bonds have had some negative years if we look at it over a 12-month period, but have given you returns of over 30% in a good year. And importantly, if I look, what this tells you straight away is that the chance of you showing a negative return over 12 months from South African bonds is very, very much lower than it is from equities, both globally or locally, and that's with the rand appreciation. Importantly, if I look at the way we manage the flexible income fund, much more conservatively than the typical bond market in terms of the kind of bonds that we invest into. Now, we can't talk about investment returns without talking about risk. And when we talk about risk, what we're really talking about is the chance of having negative returns. On average, we might get inflation plus 7 out of domestic equities, but as you can see on this slide over here, the worst return over 12 months, over the last 120 years, has been nearly 40% from domestic equities and nearly 50% from global equities. So you might have had a one great 12-month period where you got nearly 80%, you got 79% from domestic equities, but you've also got a chance of showing less than 30% over 12 months. And that is really the risk that we worry about and what we talk about as investment managers. And when we look at bonds, you can see that bonds have very seldom shown a negative return. They did have a 12-month period where they were nearly 9% down, and even over 12 months when they've been over 30%. But the variation of returns, the chance of you showing a negative return out of a bond asset is much lower than it is out of equity assets. So on average, equities should be great. It's a bit like that Ford Cortina, if you drove it down to Cape Town today. It should be okay, and it should be able to go fast, but there's also a strong chance it might break down. Now, if we have a look at how we've been managing the assets in flexible income fund over the last 5 and a bit years, we've never had a negative 12 months, even though we've been through the worst 2 biggest sell-offs in our bond market history. Our worst return over 12 months has actually been, over any rolling 12-month period, has been 5%, and our best returns 15%. So we've got a much more certain kind of environment that we're dealing with. It might not be without risk, but it's definitely a much less risky return than dealing with in the stock market, much more certainty. So can bonds continue to beat the stock market, or give us these decent returns, or give us decent inflation beating returns for the next 5 years? And you can see on the slide here how our flexible income has been able to outperform the bond market by just over 2%, 2.4%. It's beaten cash by 2.5%. Sadly, it's beaten equities by over 5% a year, which is just nearly 40% over the last 5 years, sadly enough, and obviously beaten inflation and property. But importantly, I think bonds are actually teed up quite nicely to give us good returns. We can see from a risk-adjusted basis, bonds have been even better. The flexible, we've shown just under 3% more than the bond market, but with half the variation or half the volatility of returns, and obviously much better than equities. Now, and this is again versus peer type investments as well, which are typically more cash plus in terms of how they invest. So by buying some of the fixed rate bonds, it's allowed us to add a good 2 to 2.5% over peers, as well as bonds and cash per year over the last 5 years. And still, even though we've had huge volatility during this coronavirus crash that we saw, biggest sell-off in our bond market history, we're still just under 1% ahead of the peers over 12 months to the end of July. Now, what's going to happen next? This is the key thing. As investors, we can't always look backwards, we've got to look forwards. And globally, I was showing this slide at the end of last year going into this year. This is a 700-year chart of growth and interest rates globally. And what you'll notice, particularly if you look at the last 50 years, interest rates and growth have been coming down, bond yields and GDP growth. Now, what's happened particularly since 1989 is we saw the Berlin Wall fall, the end of the Cold War. We saw globalization start. We saw costs coming down around the world. We've seen oil prices steadily actually coming down, particularly in the last decade or so. We've seen growth in developed markets has been slower because there's a lot more old people. Effectively, the developed markets are in retirement. And all this has been pointing to, even before the coronavirus, is that we're heading towards more of a lower for longer or zero interest rates in the developed markets. And I still believe that US interest rates, particularly their longer rates, will stay closer to zero and there's far more likelihood of them staying low than them going up. They've taken on a lot of debt in the developed markets, particularly post the COVID-19 sell-off now, and they're going to really struggle to grow into the future, given their aging population, the amount of debt they've got, and just costs and everything that are coming down. And it's also unlikely that we'll have anything like an oil price shock back over $100 again, given the excess production that we're seeing out of shale and the likes. Secondly, equities are expensive. This is the S&P 500. This is one way of showing it on a Cape-Shiller type basis, a more normalized basis. But whether you look at equities on an historical PE, a normalized PE, a forward PE, global and particularly US equities are expensive. And the only other times that they've been this expensive before were 2000 and 1929. And if you invested in US equities at either of those periods, you got zero or negative returns for the next 10 years. Now, I'm not calling that equities might be negative, but the chance of them showing good returns like they did over the last 10, 15 years, again, over the next 10 years is very, very low, given the valuations where they are. And if anything, if you take the current PE of the American market, it's more than double its average. That means the value can halve. In other words, prices can fall by 50% just to get back to their long-term average. Now, I'm not calling that to happen, and I think things can stay frothy like they are in the markets for quite some time. But what it is I'm not expecting really good returns from equities, developed market equities in particular, for the next 5 years. And what we've seen during, and just to put it in context here, since the coronavirus, since January, earnings estimates are down 43% this year for US equities, and for 2021 down another 15%. And the US equity market has hit an all-time high now, even though equities have effectively fallen by, the earnings have fallen by 50%. So your profits are down by 50% and your prices are at an all-time high. At the end of the day, yes, some tech stocks are immune maybe to some of the slowdowns that we've seen, but at the end of the day, when you're buying companies on 30, 40, 50 times earnings, at the end of the day, your expected returns are going to be low. And what we know, if we look at the history of US equities, and this is data from 1960, that if you buy US equities on valuations like they are at the moment, that your forward return is quite low. And on average, if you've bought equities at these kind of valuation range, you typically get, on average over the next 10 years, about 1.3% return. Now, for South Africans, that's not good enough. We better hope if you buy global equities that the rand appreciates, and it probably will continue to depreciate 5 to 6% a year like it does on average for years to come. It might be higher in some years. It might be much lower than in other years. But the point is, developed market equities where interest rates are zero, inflation is very low, growth is very low, a return of 2, 3, 4, 5% is not actually a bad return in America or in Europe, but it's not a great return in South Africa where our inflation is higher and our interest rates are higher. So this is the story in South Africa at the moment. Cash, if you look at the blue dots on the left-hand side, is around 3.4%. If you've got 100 million rand and you go to one of the banks today and you give them cash on overnight cash, that's roughly what you'll get. And interest rates could quite easily come lower, go lower than they are right now. And what the red line is what our fixed deposit rates are in South Africa. These are the bond yield curve, as we call it. But the bond yield curve basically means that if you go to one of the banks or to the government and you say, I want a 1 year, a 2 year, a 5 year, a 10 year, a 20 year, or a 30 year fixed deposit, what will the rates be that you will give me? And it shows there that the shorter term rates from 3-month rates have actually dropped below 3.5 now that you'll get from the banks. And the longer term rates are still around 11.4, 11.5%. The gap between ourselves and the blue line and the green lines, which are America and Europe, is over 10%. This is the highest it's ever been. And normally, that gap is much, much lower. It normally is just basically your inflation differential between the countries. And in a growth environment like we're seeing in South Africa, we would expect a flat yield curve. In other words, you would expect interest rates to be much lower. And if I look at the equivalents of South Africa, so not so much Europe, if I look at Brazil as an example, their 10-year bonds, they're equivalent. And Brazil, remember, is one notch below us into junk. They're in more trouble than us. And they are paying 2% less on their 10-year rates than we are. In other words, they're borrowing at 2% less. So there's something going on in South Africa at the moment. Yes, there's risk, but these longer dated rates are giving us over 11%, and with some credits that we can get in the market, over 13%, locked in fixed deposit returns. That's what a bond is. It's a fixed deposit at the end of the day. You know exactly what your return will be, and you know exactly when you're going to get your money back. The question is that yield high enough? And I'll make the argument that I think it is. What you'll see here, this is what we've seen over the last couple of months. In February, you can see our cash rates, the green line, where we could get just about 7% out of the longer dated cash rates. And the longer dated bonds were giving us about 10%. What's happened now is cash has collapsed. Interest rates on the left-hand side, you'll see below 3.5, as I've mentioned. And your longer dated bonds are still giving us higher yields. So we've seen global equity markets recover. We've seen a lot of other markets recover around the world. We've seen the currency recover even a bit. But we haven't yet seen our longer dated bonds factor in this lower interest rate environment that we're seeing right now. And importantly, you know, I grew up and I started in the markets in '99, and in the early 2000s, I was a bond and interest rate trader. And then even through to 2006, 2007, we had an inverted yield curve. In other words, I could get higher returns out of cash. In 2006, 2007, I could get 12% out of a one-year fixed deposit. And my longer dated bonds, my 10-year bond, was giving me 7 to 8%. And that is what has changed so dramatically now. So the opportunity set is here. We've seen a rally in the shorter dated bonds and something like your 6-year type bonds as interest rates have collapsed. But we haven't yet. We still see negative returns from some of the longer dated bonds. And this is where we are seeing great opportunities for conservative investors at the moment. Whether you're 25 or 85, if we can lock in inflation plus 9 yields for you, those are very, very good returns. And we still think that these rates can come down further, and there's room for these rates to come down significantly. Now, how do bonds compare yield-wise at the moment to history? And what we can see on this slide over the last 30-odd years is that the all-bond yield at the moment is 7.3%. The longer-dated bonds, as I've mentioned, are giving you over 9%, nearly 9.5%. Oh, this is real returns. This is above inflation, current inflation. And you'll see that the last time that we had real yields out of bonds at these levels was in 1998 and 2002, 2003. And your forward returns from there were very high. Because when you buy a fixed deposit at a very high yield, that's the return you're going to get. So the opportunity that's presented itself in South Africa at the moment, at closer to inflation plus 9 in the longer dated bonds, is a unique opportunity. And I would argue that South African bonds, despite the risks and the noise that we face in South Africa, are probably one of the cheapest, and on a risk-adjusted basis, one of the cheapest assets in the world at the moment. And we're yielding just over 9% in the flexible income fund at the moment, even though we've got a third of the duration of the bond market. So we've got a nice batch of the corporate bank bonds in the portfolio that are giving us nice high corporate yields in the shorter dated bonds. And then we're holding some of the longer dated fixed rate bonds, which are very liquid and add some extra yield to the portfolio. And overall, you know, it's a bit like, you know, driving from Joburg to Cape Town again. I've got that speed limit of 117. I'm still able to keep the yield very high in the portfolio, but the risk that we're taking is much, much lower. Again, it's a bit like that Land Rover Discovery, where I'm only taking, it's almost like the equivalent of driving 40 kilometers an hour, but my speed is still closer to 120 because we don't have as much duration as the bond market, only about a third of the duration of the bond market. Now, going forward, you know, at the start of the year, this is what all the other asset managers in the country thought that markets would do for the next 5 years. And you could see they thought that domestic equities would give you about 12% a year for the next 5 years, domestic property 12%, global equities nearly 11%, 10.5% with the rand appreciation. They thought that bonds would give you 9%, they thought that cash would give you 7%, and they thought that global bonds would give you about 6% with per year with the rand appreciation. Now, we were a lot more negative at the time. We weren't calling the coronavirus crash, but as I was showing you earlier, we didn't think equities were very well priced. But more importantly, if you see that red square, we were finding bonds around 11%, which just make a huge amount of sense at a much lower risk, much less volatility, much less chance of showing negative returns. It just made sense for us because we thought that cash rates were going to come down. We thought that equities and property and global equities were unlikely to give us the good returns that we had seen over the last 30 years. And again, we were lucky enough to find that the yields on the shorter dated instruments and the bonds were giving us the kinds of returns that we were hoping to get out of the stock market. So what we've ended up with now is this efficient frontier that I showed you earlier that normally has this a relationship where low risk assets give you low returns and high risk assets give you high returns. We're actually finding now that the new efficient frontier, which should drive your asset allocation, is actually pointing to us that we're going to get higher returns, potentially with a higher degree of probability, out of the bond type assets than we will out of the riskier type assets. And this is why if you look at our balanced fund, the Sasfin balanced fund, that I manage, the one that we won the Morningstar Award for this last year for the best 5-year risk-adjusted performance, we're actually only sitting at about 15% in local equities. Now, the average institutional asset manager in South Africa that we would compete with is sitting with around 40% in local equities, and they would consider themselves underweight equities. Over time, that used to be 50, 60% a couple of years ago. So people have reduced their local equity exposure, but we're finding much better opportunities in the bond market with much greater certainty. So between cash and bonds, we're over 60% in a long-term growth portfolio. So we're finding growth opportunities out of the lower risk assets. And I think this actually suits not only younger investors or investors that are wanting to grow their wealth, but obviously investors that are retired or pensioners that are looking to withdraw an income, because the income assets are much greater in the portfolio. So not only do we think we can generate growth, we know we can generate income out of a portfolio like this. Importantly, we still maintain quite a decent offshore exposure, because what we know from history, and it's likely to play out again, that in an environment where things get worse in South Africa, either for our equity or our bond market, the currency weakens quite dramatically. We saw that during the coronavirus sell-off, and we've seen it over Nenegate and other sell-offs, that the bond market might lose a couple of percent, but the currency will lose a lot more. So during the coronavirus sell-off, global equity sold off 30% and the rand lost 35%. The bond market lost 10%. We were down in March just under 1% year to date, so it was about 3% down in total, but the currency had lost 35%. So we know in a balanced portfolio that having that offshore exposure is your hedge against what goes on in South Africa. So we still maintain some global equity exposure to protect against anything going wrong on the local side or even just shorter term volatility. So what I want to leave you with here is, where would you rather live? Now, as South Africans, we know that if you move to London, you're going to have terrible weather, it's going to rain a lot, and you're going to live in a small property, in a small apartment, and even if you do have a garden, you're going to be staring at a grey sky. If you move to Canada, this is a picture of a couple of people watching an American football game, and you can see it's not pleasant. The weather's pretty harsh. You've got a couple of months a year that you can get outside. Again, your quality of life is going to drop. You're going to have a smaller house. You're not going to have the same sort of lifestyle that you do in South Africa, and even in America as well. And the same, even if you move to somewhere like Australia, you're going to have to downscale your lifestyle. But again, you could live in South Africa, and all of us answer this question probably every day. And whenever we talk to someone who's immigrated or left the country, we know why we live in South Africa. We love the country. We know that our quality of life is good. Yes, we put up a lot of noise. We put up with politicians. We put up with tax money getting misappropriated or stolen. It's a bit like our bonds. Our risk is higher, but our return is higher. Our utility for living in South Africa is very, very high. Our quality of life, our yield. And that is exactly what our bonds give us in South Africa at the moment. They give us a better return for the risk that we're taking. And I would argue that our best investment export is our interest rates. It's our bonds. And it's the most attractive thing to foreigners, unfortunately, in South Africa now. It's not as much our equity market. It's not the growth sectors of the economy. It's our yields that are attractive. They're structurally there. We know why they're there. And they are something that a foreigner is very, very happy to come and buy our bonds and even hedge out the currency and still make 5, 6, 7% in dollars. So foreigners who are getting zero interest rates around the world, they look at our local yields and they look at it, how they look at we look at our quality of life, and they see that there's a great opportunity in South Africa. They're not here yet. So like I say, our interest rates are like our quality of life. They're much higher. Global and local growth and the equity outlook is uncertain. So they're interlinked. In the short term, equities tend to run ahead of the economic growth. But over time, global developed market growth is likely to be lower for longer. Interest rates are likely to be lower for longer as well. So global equities are expensive. So while the growth outlook is not great, it's a bit like on that drive from Joburg to Cape Town. If there's mist on the road, you've got to slow down a bit. And the growth outlook is uncertain. We don't know what's going to happen as we come out of coronavirus. Things should normalize a bit, but there's still a lot of uncertainty, particularly in the local market. Global equities are expensive, which means that local equities are expensive too. There's only so much of the JSE that is actually invested in South Africa anymore. Most of it is Naspers and dual-listed companies and resource companies, which are not priced according to the South African economy. There are a handful of companies that could do really well as we come out of the coronavirus lockdown, but that's only a small part of the investment opportunity set in South Africa. So don't expect amazing returns from equities into the future. Interest rates are likely to stay lower for longer, as I've mentioned a few times. Holding cash has become expensive. It's actually become risky. So if you're going to get 3.5, if you're lucky, out of cash investments for the years to come, it's a very expensive insurance policy. If you can get 7, 8, 9, 10, 11% out of bonds, that means you're giving up 6% plus a year out of by sitting in cash. So it's becoming dangerously expensive to sit in cash because you know that the speed limit of cash is not high enough to get you to your retirement goal or your investment goal. And then SA equities, as I've said, are a bit like the 1980s Ford Cortina XR6. Fast, but unreliable. Equities haven't changed since the 80s and the 90s and even the early 2000s. That's when their great returns were. Those weren't normal returns. They were higher than the long-term averages. And given the growth outlook from here, they haven't adapted to the times. They haven't come up with airbags. They are still unreliable. You're going to have good years from equities. You're going to have bad years from equities. But you're not going to have, you're not able to avoid the real downside. So as an investor, the bonds are giving us an opportunity that I believe are the kind of opportunity as investment managers we've been waiting for most of our careers. They are cheap, they do come with risk, and they will come with some volatility, but significantly less risk than we'll get out of the equity markets. So I'm going to leave it there. Thank you for everyone for joining us, and I hope to meet with you later on in the day in the forums where I can answer some of your questions. Thank you.